There's a button that keeps you poor. You click it every month. You think it's helping. It costs you, on average, $11,000 over a lifetime, per card. And you were designed to click it. This isn't a story about bad decisions. It's about architecture. The entire consumer debt system in America, worth over $4 trillion, runs on a simple principle. Human beings are predictable, not stupid, predictable, and that difference is worth everything. The credit card sitting in your wallet right now is the result of 70 years of psychological research. Every word on your statement, every payment option, every notification you receive. They've all been tested, refined, and optimized to exploit specific flaws in how your brain processes risk, time, and money. This is the story of how financial institutions turn psychology into profit, how they built a system that doesn't just lend money, but manufactures permanent customers, and how they convinced you that the chains were your choice. Let's start with the moment you joined the system. You probably remember it, that first credit card. Maybe you were 18, 21. Maybe a bank set up a table at your college campus. Maybe you got a pre-approved offer in the mail that made you feel chosen, selected, trusted. What you didn't know is that the letter you received, the one that said "Congratulations," was written by a team of behavioral economists who understood something crucial about human psychology. We are terrible at imagining our future selves. There's a term for this: present bias. Your brain is wired to prioritize immediate rewards over future consequences. It's not a character flaw, it's evolution. For most of human history, the future was uncertain. Survival meant taking what you could get now. That instinct made sense when you were avoiding predators and competing for scarce resources. But credit card companies know this. They know that when you're standing in a store, holding something you want, your present biased brain is screaming, yes, while the part of you that has to make payments 6 months from now barely has a voice. So they designed the entire experience around that moment. The approval is instant. The credit line is generous. The reward points make you feel smart. And the bill comes later, when future you is in charge. And future you, they know, will probably click that minimum payment button. Let's talk about that button, the minimum payment. It seems reasonable. $25, $35, manageable, and right there on the statement, printed larger than everything else, is exactly how much you need to pay to stay in good standing. This is called anchoring. It's one of the most reliable cognitive biases humans have. When you're presented with a number first, it becomes a reference point, an anchor. Everything else gets judged relative to it. Credit card companies don't highlight the full balance. They don't make it easy to see the total interest you'll pay. They anchor you to the minimum. And here's what makes it brilliant. The minimum payment is carefully calculated to feel achievable while keeping you in debt for decades. If you have a $5,000 balance at 18% APR and you only make minimum payments, you'll pay it off in about, never is the wrong word, but it's close. Depending on how the minimum is structured, you're looking at anywhere from 15 to 30 years. The interest alone could be $8,000 or more. You'd pay nearly triple what you originally borrowed. But here's the psychology. Every month you make that payment, you feel like you're doing the right thing. You're being responsible. You're not defaulting. The credit card company even sends you positive reinforcement. Payment received. Thank you. Your credit score might even go up because you're making on-time payments. The system rewards you for staying in debt, and then they increase your limit. This is where it gets darker. The same behavior that keeps you trapped in debt, making minimum payments, keeping a balance, is interpreted by the algorithm as success. You're a profitable customer, so they offer you more rope. Most people accept because of another cognitive bias, optimism bias. We believe we're different. We believe we'll handle it better this time. We believe we won't use the full limit. We just want the security. The credit card company has data on millions of customers who thought the exact same thing. They know what you'll do before you do it. The increase in spending isn't sudden. It's gradual. Mental accounting is another bias they exploit. You don't see credit card debt as one large, serious problem. You see individual transactions, $20 here, $50 there. Each one feels separate, isolated, justifiable. Your brain doesn't naturally aggregate these into a growing total, but they're all part of the same system, different products, same psychological principles. The personal loan promises simplicity, one monthly payment, lower interest rate, fixed term. It sounds better. And mathematically, it might be. If you're paying 18% on credit cards and you can get a 10% personal loan, the math works. But here's what the behavioral economists know. People don't close their credit cards after consolidating. They tell themselves they will. They mean to. But once those credit cards are paid off, they feel like they have breathing room again. They feel like they're back in control. And control feels like permission. Within a year, most people who consolidate debt have run up new balances on their credit cards. Now they have the personal loan payment and new credit card debt. They're deeper in than before. The industry calls these people revolvers. They revolve from product to product, always carrying a balance, always generating interest. This is when other products start to look attractive. Buy now, pay later services, 4 easy payments, no interest. Except they've now fragmented your debt psychology even further. You've got the credit card bill, the personal loan, and 4 different BNPL installments across different apps. Your brain can't track it all, which is exactly the point. Decision fatigue sets in. You're managing multiple payment dates, multiple apps, multiple minimum amounts. The cognitive load is exhausting. So what do? You go back to the path of least resistance. Minimum payments, automated if possible. Just make it stop buzzing. The psychological cost is mounting but harder to measure than the financial one. Debt doesn't just extract money. It extracts attention, mental energy, peace of mind. Studies show that people with high consumer debt perform worse on cognitive tasks, not because they're less intelligent, but because part of their processing power is always dedicated to the anxiety of debt. This is called cognitive load theory. Your brain has limited bandwidth. Debt occupies bandwidth. It's running in the background, like an app you can't close, making you worse at your job, shorter with your family, less present in your own life. And the credit card companies know this too. They know that someone under cognitive strain is more likely to make impulsive decisions, more likely to click the minimum payment, more likely to accept the credit limit increase, more likely to stay profitable. Here's the mechanism most people never see. The one that makes all of this possible. It's not in your contract. It's not in the terms and conditions. It's in the regulatory framework itself. In 1978, the Supreme Court case, Marquette National Bank vs. First of Omaha Service Corps, changed everything. It determined that banks could export the interest rate laws of their home state to customers nationwide, so banks moved to states with no usury caps. South Dakota, Delaware. Suddenly there was no ceiling on interest rates. Before this, most states capped interest rates at 10 to 12%. It was considered usury to charge more. Immoral, exploitative. After 1978, rates climbed. 18%, 24%, 29%, and it was all legal. But here's the truly important part. The credit card. Companies didn't sell this to the public as predatory. They sold it as access, democratization. Before high interest rates were allowed, fewer people qualified for credit cards. Only the wealthy, the safe bets. The narrative became, high interest rates allow lenders to take risks on people with lower credit scores. If you want inclusion, you have to accept the price, and the public largely accepted it because the alternative, being excluded from the financial system entirely, felt worse. This is framing at a societal level. They framed exploitation as opportunity, and it worked because there was truth in it. More people did get access to credit, but access to a system designed to trap you isn't freedom. It's just a prettier cage. Even the advice ecosystem is compromised. The debt avalanche method, debt snowball method, balance transfer strategies, all legitimate mathematical approaches. But they exist in articles surrounded by ads for the very products you're trying to escape. The solution content is marketing. Financial literacy is pushed as the answer. If people just understood compound interest, the argument goes, they'd make better choices. But this is another misdirection. The problem isn't knowledge. It's design. You can understand every cognitive bias, every psychological trick, every mathematical formula, and still fall into the trap. Because the trap isn't ignorance. It's the structure of modern life. Wages that haven't kept pace with costs, healthcare expenses, education debt, housing, child care. Sometimes debt isn't a failure of willpower. It's a response to material conditions, and credit card companies know this too. Carrying a balance and making minimum payments keeps your utilization consistent and your payment history perfect. Your score goes up. You feel like you're winning. But you're paying hundreds or thousands in interest for those points. You're buying your own surveillance metric. So what happens when you actually try to escape? Let's say you get serious. You cut expenses. You increase your income. You throw every extra dollar at the debt. You're making progress, and then life happens. An emergency. Not a luxury, not a choice. A real expense that can't be avoided. And you don't have an emergency fund because all your extra money has been going to debt. So you're back to the card. This is the cycle. This is the design. They don't need you to fail completely. They just need you to fail occasionally, because every time you fail, every time you add to the balance after making progress, the sunk cost fallacy hits harder. You've worked so hard, sacrificed so much, and you're still here. Some people give up at this point. They stop trying to pay more than the minimum. They accept that this is permanent. The debt becomes like rent, a monthly expense that never ends. And the credit card company has created an annuity, a customer who will generate predictable income for decades. The scale is hard to grasp. 45% of American credit card holders carry a balance month to month. That's roughly 60 million households. The average household debt is about $6,000 at an average interest rate of 20%. That's $14 billion in interest paid annually. Not principal, interest. $14 billion extracted from the economy, not for goods, not for services, but for the privilege of having borrowed money. Money that was, itself, created digitally when you were approved. The bank didn't loan you physical currency. They changed a number in a database, and for that change, they collect interest indefinitely. Bankruptcy looks like an option, but the system has answers for that too. The 2005 Bankruptcy Abuse Prevention and Consumer Protection Act made it much harder to discharge debt. You have to prove you can't pay, submit to means testing, take credit counseling courses, and even then, not all debt qualifies. The escape hatch got smaller just as the debt trap got bigger. Credit counseling services, the legitimate ones, can help. They negotiate lower interest rates, set up payment plans. But here's the reveal. They're often funded by the credit card industry itself. The National Foundation for Credit Counseling, one of the largest networks, receives significant funding from creditors. The help is real, but the incentive structure is complicated. The math never seems to work out, even when you increase payments, even when you stop using the cards. The interest accumulates faster than feels possible. This is compound interest in reverse, the eighth wonder of the world. Einstein allegedly called compound interest, but he was talking about savings, about interest working for you. This is interest working against you, and it compounds daily. Most people think their interest is calculated monthly. It's not. It's calculated daily. Every single day, a small amount of interest is added to your balance, and the next day, you pay interest on yesterday's interest. The effective annual rate is higher than the stated rate because of this compounding. But that detail is buried in the cardholder agreement. Page 17, section 4.2. In 8-point font, everything is disclosed. Legally, technically, it's all there. The terms, the rates, the fees, the compounding structure. But disclosure isn't the same as transparency. You can hide the truth in plain sight if you make it dense enough, complex enough, boring enough. The human brain isn't built to parse pages of financial language after a long day of work. And this is the final psychological mechanism: learned helplessness. When you try and fail, try and fail, try and fail, eventually you stop trying. You accept the situation as unchangeable. The credit card bill becomes like the weather, something that happens to you, something beyond your control, except it's not beyond control. Not really. It's just beyond individual control. Because this isn't a personal problem with personal solutions. This is a systemic problem with systemic causes. The psychological mechanisms that trap individuals in debt are the same mechanisms that the system relies on to function. If everyone paid off their cards every month, the model collapses. The credit card industry needs revolvers. They need people who carry balances. Their quarterly earnings depend on it. But here's the truth that's hard to sit with. For most people, escape is measured in years, not days, not weeks, not months. Years of discipline, sacrifice, and strategic payments. Years of resisting the same psychological mechanisms that are optimized to break your resolve. Years of staying angry enough to keep fighting, but not so hopeless that you give up. And even when you win, even when you finally reach zero, you're changed. You're different than you would have been without those years of financial weight, the opportunities you didn't take, the risks you couldn't afford, the mental bandwidth that was occupied by debt calculations instead of creativity, instead of presence, instead of peace. The credit card companies count on you for getting these lessons. They count on time and distance smoothing out the memories. They count on the next emergency, the next tempting purchase, the next moment of weakness, because that's what they've learned from decades of data. Humans are consistent, predictably imperfect, reliably fallible. Right now, someone is clicking the minimum payment button for the first time. Someone else is applying for their first credit card, excited about the possibilities. Someone just had their limit increased and accepted it. Someone else is sitting at their kitchen table at 2 a.m, trying to figure out how they ended up here. The system doesn't sleep. It doesn't take breaks. It processes payments and calculates interest and sends targeted offers every second of every day. It's vast and impersonal and relentless. And it was built piece by piece, psychological principle by psychological principle, to keep you exactly where you are. The question isn't whether the system is designed to exploit you. It is. The evidence is overwhelming. The question is what you do with that knowledge, how you move through a world where every financial product is optimized against your best interests, where every interface is designed to nudge you toward profitable decisions, where your cognitive biases are mapped and leveraged and monetized. Maybe you pay it off over 5 years instead of 30. Maybe you never carry a balance again. Maybe you organize with others to demand regulatory change. Maybe you just become harder to manipulate, more aware, less automatic, more deliberate in a system designed for automation. Or maybe none of that happens. Maybe you click the minimum payment button tomorrow just like you did yesterday. Maybe the psychological chains are stronger than awareness. Maybe understanding the trap isn't the same as escaping it. The credit card companies are betting on the latter. They've run the numbers. They've studied the outcomes. They've invested billions in behavioral research and interface, design and customer retention strategies. They believe that most people who learn how the system works will stay in it anyway. Because leaving requires not just knowledge, but sustained effort against psychological currents that flow in the opposite direction. Are they right? That's not a question with an answer. That's a question that every person trapped in debt has to answer for themselves every month, every payment, every choice between the minimum and something more. between understanding and action, between awareness and change. The button is still there. It's still glowing. It's still easy to click. And someone, somewhere, is clicking it right now.